Hello everyone, this is Chuck Carnevale, co-founder of FastGraphs, the Fundamentals Analyzer software tool. And I'm doing something a little different with this video. We've been in a very long bull market, since really the April of 2009. We've seen the stock market really rise rapidly. This is the S&P 500 looking at operating earnings. And I'm going to talk about valuation in a minute, but the point I want to make is this kind of long-running bull market has really started to cause some angst, I think, in a lot of people. I'm starting to hear more and more people worried or asking me, is this, is the bull market going to end soon? Are we going into a recession? Is the market going to crash? And see, I never think too much about the market. Instead, I like to pay attention to the individual stocks that I own or that I'm interested in learning about or investing in. So I don't really spend a lot of time worrying about the market. But let's look at valuation relative to the overall stock market now, because one of my mantras, as many of you know, is it's a market of stocks, not a stock market. Now, this is the aggregate S&P 500, and I'm going back here to 2000. And the orange line is a 15 PE ratio, and it's a theoretical normal or fair value for the market. And you can see over this time frame, there's been quite a few times where the market has traded at that. We'll call it attractive PE ratio, but then there's the normal PE on this graph, which is about 18.87. Now, this number is skewed a little bit because we had very high PE ratios up here at the beginning. All right, so at this iteration, the market looks like it's fully valued or just at value if you're using the blue line as your valuation reference. But I do want to call out CULL, that irrational exuberant period there, and look at the market just since 2006, a couple of years before the Great Recession when the market was trading at about a 16 PE in January of 06. And then look at it from this perspective, we now see a normal PE of about 17.6. And by the way, the long-term average has been somewhere between 14 to 18, 15 to 18. As you can already see here by this really short exercise so far, it varies depending on the market environment. But this all relates to earnings yields, and I've written and talked about this many times before. And I don't really want to get off on that or into that. But the point is that what you're looking at here is a market that's on the high end of its normal valuations, at least since 2006, and going all the way back to 2000, as far as I can go back, it would still be classified as fully valued. I don't consider this dangerously overvalued. Now, I want to emphasize that by going back to the long-term graph. What we had coming into the 01 recession, the Irrational Exuberant Period, which I was just recently asked about by a subscriber, I hope you're watching the video, that was a period where the market's really, Ellen Greenspan called it the Irrational Exuberant Period. We really had excessive valuations during that time frame. And then as we came into the recession of 01, we were very vulnerable, and the market, for the next couple of years really was weak. And then as we came out of that recession and earnings of the market started to build again, we started to see some, good performance. And then, of course, we hit the big doozy here, the 2008 recession, financially driven primarily, at least from my point of view. And we did see a rather severe drop in the earnings of the S&P. It fell 6% in 07. That's this little dip here. And then, of course, it fell by 40% in 08. And at this point, you could argue coming into 08 that the market was at the full value range of its normal valuation. The PE was about 18.67, and this blue line is 18.87. So that's more or less identical. So we had this from the time frame I'm measuring here, which is November of 07 down to the end of March in 2009, we saw a 52.6% overall drop in the market. Now that's more than a year's time there. So it's an annualized rate of return of about negative 40.7% over this time frame. And everyone, reacted to that, and it was severe. And then since that time now, since, March of 2009, we've had this very nice bull market where we're averaging over 15% returns. And I might point out the long-term average for the market's been about 6 to 8%. So this is almost double, I would say, the normal average. But let's look at how it happened. First of all, the market did get down to a 15 PE ratio here. The PE that I measured was 14.3. So we've had growth. The market has grown very, well, I'll say at above average rates during this time frame. Let me try to get that as close as I can. We're looking at the earnings of the S&P have averaged over 11% during this time time frame. If I add this year in, it's still over 11.68%. That's about double the normal growth rate of the aggregate market when you're measuring the aggregate or all 500 companies in the S&P 500. So this has really been a very excellent period of time for the markets. And so on that basis, it looks good. And then if you look at it, we would argue, I think it would be very easy to argue that the overall market as measured by this index is fully valued to not slightly overvalued. But that's not Armageddon numbers, by the way. That just simply means if you look at what I call my valuation corridor on fast graphs, it's just a tad above that based on continued estimates going forward. And see if we have a long-term, growth rate of about 8.5% being forecast. This is a 3 to 5 trend line growth rate. So we're just outside of the valuation corridor. If it traded at a 15 PE and all this were to come to pass, you'd still have an average rate of return of 5%. If the market traded at its, 18 plus PE, you could still look at a market that could deliver 8.75%. And if it got at a real high PE, like a 19 PE, we could end up getting into double digits. So although I consider the market fully valued, if I was an index investor or an ETF investor or perhaps even a mutual fund investor, and what I'm saying there is, if you're investing that way, if you're buying funds or ETFs, then you end up becoming the market. In other words, most of those types of packaged investments will carry hundreds of stocks, some of them thousands in some cases, but they start to become, if they're not a mirror of the market, they're certainly become very, very market-like. So if you're investing in those kinds of instruments, then worrying about the relative level of the S&P 500, for example, or the Dow Jones or the overall market might have some credible reality in your life. You might want to really worry about that. But the point is, if you're an individual investor and a long-term individual investor as yours truly, and you're building your portfolio one company at a time, as I do, and you own a relatively select group or universe of common stocks, then, as I said in the written portion of this article, you want to mind your owned, not own, your owned businesses. In other words, pay attention to what you actually own, because that's going to be much more relevant than what the overall market is. And what people don't understand about this concept of it's a market of stocks, not a stock market, when you look at the aggregate, you're seeing this one overgeneralized point of view. But if you start looking at individual stocks, you start to get a totally different perspective at all. You start to learn that stocks are even more different than, I would argue, than people are. So let's go through a couple here, and let's look at the first one. Here's AmerisourceBergen, and I'm going back to 2000. I want you to notice a couple of things about this stock, and keep that S&P 500 picture we just had up in the back of your minds. Number one is take price off of the graph, and I want you to see that you got a very consistent company that's growing at almost 15% a year. And by the way, that's even faster than the market has grown, since the beginning of 2009, as I showed earlier. Then when you look at it from a price point of view, I want you to notice that the price, as it will almost always do, will track the company's earnings, but there will be periods of time where the markets get disconnected. I have a money management firm that I've run for decades now called EDMP, which is an acronym for Earnings Determine Market Price. And that is qualified by saying in the long run. And this whole value investing concept is about the long run. But there's also an evil twin sister EDMP that covers the short run that states emotions determine market price. And those emotions, of course, are typically fear and greed. So you will get periods when the market gets, very greedy, and you will get periods where the market gets very fearful, like we saw in the Great Recession, and like we're seeing right now on this particular financial company. But I want you to just notice the nature of this beast. It's a very, very consistent, relatively fast-growing company. And when I look at it from a performance perspective, one thing that we do on the Fast Graph tool is we always compare it to the overall market. And the reason for it is more than just whether it beats the market or not, because I really don't care about that as much as what I want to point out is it's a totally different concept. In other words, the stock market over this time frame, this identical time frame, September 30th, 1999 to yesterday's close, would have turned 10,000 into 23,600, paid you about $3,900 in dividends, gives you a total of 27,500 plus, or a 5.2% rate of return return, but compare that to AmerisourceBergen, that same 10,000 would have grown to 152,000, paid 18,700 in dividends, bringing the sum total to 171,000, and that's a 15%. It's triple the rate of return, if you will, and many times more on just a total dollars that you would have got by investing in Amerisource compared to the S&P 500. So with my first example, I looked at a very fast-growing financial company that also paid dividends. Now I'd like to switch, and with Amazon, since Amazon doesn't really care about profitability, almost analogous to me not caring about the overall market. You know, Jeff Bezos cares about cash flow. I'm measuring Amazon since 2003 based on operating cash flow. In this case, I want you to see that the stock price has tracked operating cash flow. The correlation is extremely high. Operating cash flow has grown at 34.7%. That's the valuation of the orange line. The normal price to cash flow has been about 27. That's the blue line, or the best fit line. And the point is that you can see how the business performed is how this particular stock performed. And even without dividends, the rate of return was extraordinary. $10,000. That's a slightly different time frame I chose here now for Amazon. The market would have grown to 33,000, paid about 4,900 in dividends, giving you an 8% rate of return. Amazon would give you a 30.8% rate of return, turning 10,000 into 927,000 without even paying a dividend. My point is, how could you possibly think about the market if you owned Amazon? What's really important is how Amazon is doing, not the stock market in this case. Now, for sake of time and brevity, I'm going to start going a little faster. My next example is another non-dividend paying stock, Cigna Retail Group. They own things like the Dress Barn, etc. If you look at this stock, first of all, you see the very strong correlation between price and earnings that I talked about earlier. You see where earnings went, price was sure to follow. But in this case, you see, a lot of cyclicality, but you see collapsing earnings since 2012. And now when you look at the performance of this stock and compare it to the S&P, it would have turned $10,000 into $1,500 and paid no dividend income, or very little. And, compared to turning 10,000 into 27,000 in the stock market. And again, I have a slightly different time frame because of the age of this company. My point is, what does this stock's performance have to do with the market? And if you owned this company, it really doesn't matter what the market's doing. It only mattered what your company was doing. And by the way, in this case, it wasn't doing quite well. Now, next, I want to go to one of my favorite stocks on the planet, and I've never been able to own this company because I've never found it cheap enough when I had money to be willing to buy. This is Church & Dwight. Now, this company has grown faster than the market, averaged about 13.67%. It hasn't grown as fast as Amerisource, I might add. It does pay a dividend, that you can see here, and I should add the dividends on top of the orange line here. But I want you to notice the valuation of this stock relative to its earnings growth. It was tracking it pretty closely, if you will, up through 2000 and let's say 9 or 10. And then more recently, this stock has become significantly overvalued. And, one thing about it, you're starting to see a potential little crack in the armor here. When stocks get overvalued, they become very, very vulnerable. But the point is, the market may or may not be overvalued. Now, it might be fully valued, as I said, but this stock to me is clearly overvalued. It is a great business, has one of the most consistent records of earnings and dividend growth. And notice that they really increased their payout ratio here. But the stock is priced for perfection. And this is a classic example of what I call the definitive appreciation, is when the other person appreciates the company or the stock more than you do. And the market definitely appreciates Church & Dwight a lot more than I do. Now, from a performance point of view, this has been an awesome performer, dramatically outperformed the market. And I'll let you, without quoting the numbers again to save some time, you can see that it's dramatically outperformed the stock market on both dividend income and capital appreciation. But I do want to point out, you can attribute a lot of that to the growth of the business, but you can also you need to make sure you attribute a lot of that to the high valuation. If this stock was trading, and I'm going to not get this perfectly, more in line with its fair valuation, that rate of return wouldn't be quite near as good as what we see if we're looking at measuring this stock from this point up to its high valuation. You can see, the vast differences in what the performance would have been by looking at this stock. Now, this is a great company. I love the stock. I consider it significantly overvalued, however. But the point is, what does Church and Dwight's performance have to do with the market? Here's Cigna, another fast-growing non-dividend paying stock. It's fairly valued to moderately undervalued in contrast to the market. It's another stock that has dramatically outperformed the market. And this performance, the point I keep trying to drive home, this performance has nothing to do with this, which is the stock market. It has nothing to do with how well the market did or whether the market was high or whether the market was not high. It had everything to do with how fast this company grew and what the attractive valuation was at the time you'd have been able to buy this stock. I want you to notice that Cigna was fairly priced here, and it's almost fairly priced again, so we're getting almost the full benefit of that 11.9% growth, even without the dividend. Now, this next example is another non-dividend paying stock, but I just really fascinated by this picture. It so clearly illustrates how the business results are what really drives the price. You can see the stock price following the company's operating results almost perfectly, up, down, and sideways, if you will. And, here, once again, if I look at it from a performance point of view, if I compare this to the overall market, it has buried the overall market. It has dramatically outperformed the stock market. It's done it with a lot of cyclicality in between. There's been some, issues in terms of earnings growth. We've had a 78% drop in earnings in 2007. By the way, staggering performance during the Great Recession in 2008. A couple years ago, we had another 59% drop in earnings. And of course, the stock price followed that. But all in all, this is all about how America's car mart performed, not how the S&P or the quote-unquote stock market performed over that period. My next example, I want to show CVS, a good dividend-paying stock with a 2.6% yield. You can see the price follows earnings again. It got way overvalued in 2015. It's now way undervalued. And the fact that this stock is so cheap now doesn't really matter what the market's doing. It's how is the market valuing CVS, not how the market is valuing the aggregate, if you will. Even with this undervaluation with CVS, you have significant advantages over the S&P 500 because of the business results, even though the market's undervaluing them. It's a market of stocks. My next example, I'm going to look at Royal Bank of Canada. This is about a 12 multiple stock, which is the blue line on the graph. This is using Canadian dollars in this particular iteration, but I want you to see the dividends increased, the prices increased, the performance of this stock doesn't relate to the stock market at all. Significantly different results. So if I owned the Royal Bank of Canada, and I do have it in portfolios, what do I care what the S&P is doing, or what do I care what the valuation of the S&P is? I only care what Royal Bank of Canada is. Now, I do want to shift gears here and show you one of the premier master limited partnerships, midstream oil and gas pipeline companies on the planet, Enterprise Products. I want you to notice a couple things. We got a 7% dividend yield. This stock, has tracked this. I use operating cash flows when I do MLPs. When I compare its performance next to the stock market, the overall market, look at the dividend advantage. Now, it's doubled the S&P roughly in terms of capital gain, but look at the income advantage. So if I'm investing in Enterprise Partners, I don't care if the market's overpriced or not. I care what my yield is. I care how this particular business is priced relative to the market. So the point of this is it's a market of stocks, not a stock market. And I'm going to do one final stock here that I think really illustrates how varied and different stocks can be. I'm using operating cash flow here, Kluge and Safa Industries, just a really diverse company, very almost complex. But look at the performance results of this company. This has nothing to do with the stock market. This has everything. This company is so different than any of the other ones I showed you. If I owned this stock, I wouldn't be thinking about the stock market at all. I'd just be thinking about this particular company. So at the end of the day, it's a market of stocks, not a stock market. And what that means is quit worrying about what the market's doing. Quit worrying about the market's going to crash or not. Quit worrying about there's going to be a bull or bear market. Focus on what you own. Focus on the attributes of the individual companies and recognize the companies are far too different to be thought of in general terms. Anyway, that's my view. This is Chuck Carnevale saying thanks for watching. If you like what you saw here, please, subscribe to our YouTube channel. We have, a lot of new stock recommendations coming up, and I'm going to be trying to create some real good features. As usual, we always appreciate subscriber feedback. So, let's help us grow this YouTube channel. Give us a like and hit our subscribe button. Thanks for watching.